For this session, we will talk about leverage and dividend policy. As we said before in our introduction on this subject, that when we talk about leverage, we need to learn how much out of our total assets is financed by your long-term debt or equity. So asset is equal to liability plus equity. So we need to determine the portion that is financed by liability and by equity. That's what we need to talk about your leverage. And we see the effect of this leverage as to the cost of your debt. So for your leverage, mainly we will talk about financial leverage. And for financial leverage, it means that we are leveraged more into your debt. And the cost of your debt is interest. We need to determine the effect of that interest as to our earnings per share. Okay? So later, we will discuss the effect of that interest as to our earnings per share. So that's what we will talk about your leverage. For dividend policy, we will talk about the payment of your dividends. So the different policies regarding your dividends and the effect on your different market ratios, the effect on your different market ratios. So mostly this topic is more on the cost of the finances. Remember, the cost of your debt is interest and the cost of your equity is more of dividend. So we look now into your interest and dividend, their effect as to your income and their effect as to your market. So for interest, we are more concerned as to their effect on our APS, and your dividend, we are more concerned into their effect into your market ratios. So these are what we will talk this session. So let's start. Let's start by having a review of our capital structure. As we said before, your asset or your capital is consists of different long-term sources of funds. Because when we talk about financial structure, it is more of current liabilities. If we are talking about capital structure, it is your long-term sources of funds per financial management. And for capital structure, we need to optimize it, meaning we need to get for the lowest weighted average cost of capital so that we have an optimal capital structure. So we look into our lowest possible combination of sources of funds based on our WACC to get for the optimal capital structure. Now, we look into your financial leverage. So, when we talk about financial leverage, it refers to the extent to which a firm relies on debt. So, mainly you hear the word leverage for business purposes. So, if you are leverage for business purposes, it means that you are financed out of something. So, when we talk about financial leverage, we look into the portion of this debt which make up the asset. So the more debt financing a firm uses in its capital structure, the more financial leverage it employs. Again, the greater the debt, of course, the greater the financial leverage. So as we go through, we need to examine the effect of this financial leverage as to our earnings capacity and also to our different ratios relating to earnings. So financial leverage. We have a positive leverage if the return on assets is greater than the cost of debt financing, and a negative leverage if the return on assets is lesser than the cost of the debt financing. So cost of debt financing generally is your interest. Okay. Remember, your assets came from your debt. Okay. Now, you need to make use of this asset for your operations, mainly for earning purposes. And how do we look into if ever we really make use properly our assets by using your return on assets generally, that is net income all over total assets. So the percentage of your net income over your total assets. If if it means that you have a high return on assets, then the cost, it means that you make use properly the debt for your operations, or you make use for the cost of your operations. So let's look and trace it back again. Your assets came from your debt. And of course, to finance that asset is that debt. Now, your asset is used for your operations or for your earnings. And to look into whether you really make use of your asset, the main ratio that we look into is your return on asset. Now, when we say positive leverage, we look into how much is our income or how much did we maximize our financing. If our income is greater than the cost of that financing, of course, it is positive. So return means the income over that financing is greater than the cost of that financing. So the return on asset is greater than the cost of it. Therefore, it is a positive leverage. But if the return on it is lesser than the cost of that particular financing, then it is a negative leverage. Okay. So just the reason why we place return on assets here rather than income, because mainly we finance so that we have an asset for our operations. So let's look into if there is a return out of our assets, because whatever is the return on that asset is considered the return out of the financing. So if the return is greater than the cost of that financing, of course it is positive. But if the return is lesser than the cost of that financing, it is negative. Okay, please do not forget that asset here in your financial management, of course, comes from liabilities and equity. All of our lessons revolve around these items. All of our lessons, we mainly start with these items. So if you know the relationship now, and of course, you know how did we finance that, what is the effect, the different ratios pertaining to it, I think you can properly manage your finances by now. Okay, so that is your financial leverage. If your business is more inclined into financing through debt or your liability, then therefore you are financially leveraged or you have a high financial leverage. And we look into whether that leverage is positive or negative. How? By comparing the return on assets as to the cost of debt financing. What is the cost of debt financing again? Interest. So how do we measure your financial leverage? One measurement of your financial leverage is your debt to equity ratio. So debt to equity ratio is equal to your total debt over total equity. Mind you, this was already placed as part of your financial statement analysis, uh, which I gave you as a reading assignment. As I told you, some of those ratios will come out from time to time. So they are as you can see, every time you have different topics, some of those ratios come out on our topic. So what is the use of this debt to equity ratio? It helps the company's management, lenders, shareholders, and other stakeholders understand the level of risk in the company's capital structure. Sir, why do we say that there is a level of risk in the company's capital structure? So take note, your capital structure is composed of either your debt or your equity. What is the cost of your debt? Interest. What is the cost of your equity? Dividends. Now, for your dividends, there is no fixed dividend. There is no fixed dividend unless that is a preference share. But for a dividend, it is up to the company. It is up to the company whether to declare a dividend or not declare dividend. Okay? That is for equity. Therefore, equity as a type of cost, which is the dividend on the equity as a type of cost, is more of in the control of the entity itself or the company itself. Hence, there's no risk. There's no risk. Our main risk is as to our debt. Our main risk is as to our debt. That's why mostly to measure this, we use your debt to equity. Sir, why is the risk in the debt? Because interest is always fixed, meaning whether we have income or not, whether we have income or no income, we need to pay interest. Whether we have income or no income, we need to pay interest. So see the difference. The risk is more on the debt. That's why the the use of this ratio is more on financial leverage because if we employ more debt, it means it is risky. Why? Because the company must pay, whether or not the company is earning. While if equity is greater than debt, we do not have a risk. Sir, why is there no risk if equity is greater than debt? Because if you are financed more on equity, again, the control is within the entity. But in debt, there's no control on the entity. You need to always pay. So the stakeholders or the shareholders would properly understand now the risk. Because if ever the income will increase or decrease, of course, it affects it affects the company as to whether they could pay or not. So, what are the risks of financial leverage? A leveraged capital structure subjects a company to fixed interest charges, which contributes to earning instability. As I told you, whenever we have a higher debt or we have a financial leverage, then we have fixed interest payments. And that fixed interest payments, whether or not you earn enough income, you must pay it. Whether or not you earn enough income, you must pay it. Now, the problem is that we have instability as to our earnings. So, if ever, what if we cannot cover it? What if we cannot cover it? So, it affects, of course, the business itself and of course what it gives off to your different stakeholders, whether that is an investor or a lender or just any stakeholder of the company. Furthermore, excessive debt may also make it difficult for the firm to borrow funds at reasonable rates during tight money markets. Sir, why can we not borrow funds during tight money markets? Okay, let me tell you. You have tight money. Now you are more financed into debt. You are more financed into debt. So you have already interest. You have already interest, which is already high, of course. So you are financed more into debt. You have high interest. If you add more debt, of course, the question here is, can you still cover the additional interest considering you have tight money markets, meaning not much enough cash flow. Can you still pay off your additional debt? Of course, you cannot. Therefore, it is difficult for you to get additional funding from debt. And take note, which is easier to raise? Is it debt or equity? Of course, when you expose your equity already, you cannot raise any equity. The next thing that you can raise is, of course, debt. Remember, for equity, you only have maximum number of shares to issue, depending on what is approved to you or what is approved for you by the government. So if the government only approve up to 10,000 shares and you already issued all of those shares, of course, the next that you could raise is your debt. What if you have enough debt already? So high debt already. Can you add more debt? I don't think so. I don't think so because you have now a problem whether you could cover the interest on that additional debt. Especially your cash flows are not that great. So these are the different risks of financial leverage. So when we say optimal capital structure, always remember you must properly weight the cost of that interest and the cost of that dividend so that you don't have this risk. So that you don't have this risk. So After knowing the different trees of financial leverage, let's look into the effect of financial leverage. So what is the effect of financial leverage? An increase in the firm's earning before interest and taxes results in a greater than proportional increase in the firm's earning per share. But if there is a decrease, it's more than proportional decrease in the firm's earnings per share. So here, any increase or decrease, the effect on the earnings per share is more than the increase or decrease. So for example, if the increase is 5%, the effect on the EPS is more than 5%, let's say 15%. That is the effect of your financial leverage. Sir, why? If you still know how to compute for your income here, so a bit less interest, so earnings after interest but before taxes, less taxes, earnings after interest and taxes. Okay, so this one, the EBIT can change, meaning your earnings before interest and taxes can always change, but your interest, take note of that, that is fixed. Therefore, if this will increase, this could also increase, but greater increase. But if will, but if EBIT will decrease, this will also decrease, but greater decrease. So if the increase or decrease, for example, is 5%, the increase or decrease on our EPS is more than 5% because interest and taxes here are not variable. Interest is fixed, therefore, it does not follow that the increase is the same as to the EPS. It is fixed. Okay? Sir, why? Because if the interest is variable, meaning it goes together with your EBIT. So whatever is the change in the EBIT, that is also the change in your EPS. However, since the interest is fixed, therefore the change in the EBIT, the effect on the EPS is more than the change in EBIT. Take note of that. Any change in EBIT, the effect on the EPS is more than the change in EBIT. Why? Because the interest is fixed. It is not variable. It will not go through with the EBIT. It is always fixed. Therefore, if it will not go with the EBIT, then what is the effect on our EPS? Greater than the change in the EBIT. Okay? So I hope you got this one. Uh, So this is what we were talking about a while back. EBIT, less interest. We have your income before taxes. And then we have less taxes, that is your profit after taxes. Less preferred stock dividends, that is your earnings available for common stock. So to compute for your EPS, earnings available to common stock divided by common stock outstanding. Okay? So let's see if ever we are correct in what we have said. A while back, we said that if there is a change in EBIT, the effect on the EPS is greater than the change in EBIT. Okay. So we have here 40% increase in EBIT, 40% decrease in EBIT. Okay. So Chen Foods, the small Asian food company, expects EBIT of 10,000 in the current year. It has 20,000 bond with 10% annual coupon rate of an interest and issue of 600 shares for annual dividend per share preferred stock outstanding. It also has 1,000 shares of common stocks outstanding. So uh, there is a 40% increase in EBIT and a 40% decrease in EBIT. So EBIT, RIG. So what is the original EBIT? 10,000. So plus 40%. So 10,000 plus 40% is 14,000. less 40%. 10,000 less 40% is 6,000. Now we compute for our interest. We have 20,000 bond, 10% annual, 20,000 times 10%. How much then is our interest? 2,000. Okay? So how much is our profit before taxes or your earnings after interest but before taxes? So 4,000, 8,000, 12,000. Notice, guys, as I told you, whether or not your EBIT will change, your interest will remain the same. So we have here your fixed interest, less 40 plus 40 is still at 2,000. Next, we get your tax. Let's say that the tax is 40%. 40% of 4,000 is 1,600. 40% of 8,000 is 3,200. 40% of 12,000 is 4,800. So profit after tax. So 4,000 less 1,600. We have 24. Sorry. 8,000 less 3,200. We have 4,800. And then 12,000 less 4,800. We have 7,200. Okay. Less dividend for your preferred stock, 600 shares times 4, 2,400. So income for common stock, 0, 2,400. And then we have here 4,800. Divided by your common stock, 1,000 shares, 1,000 shares, 1,000 shares. How much then is our EPS? 0 here. 2,400 divided by 1,000 shares. We have 2.4 EPS. Then we have 4.8 EPS. Okay? So to compute for the percentage change, so the new less original divided by original. Okay. So this is 0. The new EPS less the original 2.4 EPS divided by the original 2.4 EPS. So negative 2.4 divided by negative 2.4. So we have a decrease of 100%. How about for 40%? So this is 4.8 new less the original divided by 2.4. 4.8 less 2.4 divided by 2.4. 100% increase. Okay. So this is a decrease and an increase. What is our rule again? A change in EBIT have a greater change into your EPS. So what is our change in EBIT? On our case one, the change is 40% increase. What is the effect on our EPS? 100%. Is 40%, is 100% greater than 40%? Yes. Case 2. We have 40% decrease in EBIT. What is the effect on our EPS? A decrease of 100%. So is there a greater change in EPS? Yes. So that's the effect of your high financial leverage. That is the effect of your high financial leverage. You have greater change in your EPS. So it's very sensitive on your earnings per share. Okay? So as we told a while back, a change in EBIT is more than the change the effect on on the EPS is more than the change in the EBIT. Okay. Now we look into degree of financial leverage. A degree of financial leverage is a leverage ratio that measures the sensitivity of a company's earnings per share to fluctuations in its EBIT as a result of changes in its capital structure. So the first formula is DFL is equal to the change in EPS divided by the percentage change in EBIT. So a while back, we have 100% change in EPS all over 40% change in EBIT. So we have 2.5. Or DFL is equal to EBIT. So our EBIT a while back is 10,000 divided by EBIT less interest. Our interest is 2,000. Less preferred dividends multiplied by 1 over 1 less tax rate, which is 40%. Lipat natin to. So we use the second formula. EBIT is 10,000 divided by EBIT less the interest, 2,000 a while back. Preference dividends is 24 multiplied by 1 less 40% tax rate. How much is that? So we will still get 2.5. Okay? So whether you use the first formula or the second formula, you will get the same degree of financial leverage. DFL means that for every 1% change in EBIT or operating income, EPS would change by the DFL. Let's see. So if there is a 40% change in EBIT, you multiply it to your DFL, you will get now your EPS, 100% change. Is it correct? Yes, because we have computed that a while back. That if we have 40% increase or decrease, we have 100% change because of the DFL. How do we compute for the DFL? Percent change in EPS divided by percent change in EBIT, or EBIT divided by EBIT less interest less preference dividends multiplied by 1 less tax rate. Okay? Anyway, we already computed this one manually a while back. So whether you use that or you use this, we still have the same answer anyway. So what is the change or percentage change in EPS? 100%. That is equal to your EBIT percentage change. EBIT percentage change multiplied by your DFL. Multiplied by your DFL. Yeah, we're done with this. Now we look into your measures of financial risk. The financial risk of the company's capital structure can be measured by a debt ratio or debt to equity ratio or by the interest cover. So we already talked about the financial risk brought to you by your debt, which is your financial leverage, your debt to equity ratio. Now we look into your interest coverage ratio. Interest coverage ratio, or also known as your times interest earned. Okay, let's see why is it called interest coverage or times interest earned. So interest coverage ratio or times interest earned, this is the number of times interest is earned, is a measure of the debt position of a firm in relation to its earnings. So how many times can your income cover your interest? So how many times does your EBIT cover your interest? That's why the formula is EBIT divided by interest expense. Of course, it is a measure that you can pay off your interest. It is a measure that you can pay off your interest. This must be more than one. This must be more than one. So for example, if your interest is 2,000, you must have at least an EBIT more than or equal to 2,000 so that you can cover your interest. Sir, what if I do not have that amount? It is more than my interest. Therefore, you are really risky. You are really risky. As much what we look is that a company of course, that can pay off their interest when the interest comes due. So we already finished talking about financial leverage, the effect of that financial leverage. We look into the effect, of course, into the risk and on our different ratios. We talk about EPS, debt to equity, and your interest coverage ratio. Now we go with your dividend policy. So as part of your dividend policies is that it came out from your retained earnings, right? So from your retained earnings, you could either reinvest that or return some to the investors by virtue of a dividend, by virtue of a dividend. So let's talk about this retained earnings or our only internal source of finance. I have already told you before that your retained earnings is your lone internal source of finance. So internal source of finance include retained earnings. So what is a retained earning? A retained earning is a surplus cash that has not been needed for operating costs, interest payments, tax liabilities, asset replacement, or cash dividends. So any income left after those priorities of the company. So any income after costs, payments, liabilities, replacement, that is your retained earnings. So as I told you, your retained earnings can be used to pay off for your dividend. So to pay off your dividend, we need to learn what are the necessary policies or views as to payment of dividend. So before we go into the different views or policies, we first discuss what is a dividend policy. A dividend policy is a decision that firms make about whether to distribute cash to shareholders, how much cash to distribute, and by what means the cash should be distributed. As you may infer from the definition of your dividend policy, it is more of a cash dividend. It is more of a cash dividend. So here we will learn what are the different policies on how do we pay them, what to pay them, or when to pay them. So a company must restrict its self-financing through retained earnings because shareholders should be paid a reasonable dividend in line with realistic expectations, even if the directors would rather keep the funds for reinvesting. As we said a while back, your retained earnings can be used for reinvestment as an internal source of finance or as a payment for dividend, as the payment for dividend. If I am the owner, of course, I would rather use it as internal source of finance because we do not need any external funding anymore. We do not need any external funding anymore. However, we need to pay off dividend. Why? Because the dividend shows how the company operates. It signals the operation of the business, whether the business is doing good or not, whether the business is fine or not. Therefore, even if we really want to just reinvest it and use this retained earning for the financing of our operations, we would rather at least give dividends so that it could signal our investors, it could signal our stakeholders that we are earning, and that we are doing great in our operations. Okay? So as we said in this particular slide, you must not restrict your self-financing because we need to pay off your shareholders a reasonable dividend. So even if you always want to reinvest it from time to time, of course, you must pay dividend. You must pay dividend. Furthermore, the dividends the company pays may be treated as a signal to investors. We have already said that. The dividend declared can be interpreted as a signal from directors to shareholders about the strength of underlying project cash flows. So as you can see from your operations, if you pay your shareholders, kumita pala yung investment ko. Kumikita pala yung company. So that can be considered as a signal to them, as we have discussed in the previous slide. Now, let's look into the different views and also your different dividend policies. So, there are two theories of dividend policies. Two theories of dividend policy. We have your residual and then traditional. Let's start first with your residual. So for your residual dividend policy, it can be summarized as follows. If a company can identify projects with positive NPVs, it should invest in them. Only when these investments are exhausted should dividends be paid. So what you do here is you have here your retained earnings. First invest. And then if there is an excess or what we call residue or residual, that is now for dividends. That's how it works on that theory. So for residual, uh, your main priority is to invest. Your second priority is the dividends. How about your traditional view? Your traditional view is to focus on the effects of dividend and dividend expectations on share price. So here you look into also the effect as to your stakeholders. So no priority. In your residual, there is actually a priority, which is to reinvest. Your second priority is for your dividends. Here, no priority because you always think that the dividends provides expectations and of course, it signals your investors, as we said. So if ever we keep on paying dividend, of course, the price of our share increase, and this could expect uh, future dividend growth and a higher rate of return to different shareholders. So if ever, on the part of the investor will think that this company is paying this type of dividends for sure. Soon, sooner or later, they will pay a higher amount of dividend. I think I should invest on this company. Okay, so see the signal it gives to the investors, the expectation it gives to the investors. So that's the traditional view. So either residual view or traditional view. It depends on the entity because as I said, dividend, there is no fixed amount to pay. It is really on the control of the entity. It depends on the entity whether they should pay a dividend or they should not pay a dividend. So since we keep on talking about dividend, what is a dividend? The term dividend usually refers to cash paid of earnings. We call that your cash dividends. So what are the different dividend policies? So the first dividend policy, actually we have only two dividend policies. We have your constant or your fixed dividend policy, and then we have your uh, no, constant or a percentage, and then we have your fixed amount. So let's start with your constant payout ratio. The firm establishes that a certain percentage of earnings is paid to owners in each dividend period. So for example, it provides 5% of earnings is given. So that is a constant payout. How about your fixed amount? So when we say fixed amount, or regular dividend policy based on the payment of a fixed dollar dividend in each period. If the constant is a percentage, your fixed amount is a money. So let's say 5 pesos per year that can do. That is considered a fixed type of dividend. So constant or fixed. Those are two types of dividend policy. So we have two views, the traditional and the residual. And then we also have your two types of dividend policies, your constant and your fixed. Now we talk about the effect of these dividends to your market. So as I told you during our introduction, the payment of your dividend signals your investors, therefore it signals the strength into the market. So we look into your different market strength ratios. So when we talk about market strength, they relate the firm's stock price to its earnings, book value, sales, cash flow per share. They also include dividend-related ratios. So we look into the effect now of that particular dividend and what does it say to your company. So the first ratio that we will talk is your price earnings ratio. The price earnings ratio or multiple reflects to some extent the growth potential of a company and the market's evaluation of the firm's earning. So as you can see, we look into the relationship of your income and to the uh, market market price of the company's share. So based on your earnings and the market. So that's why price earning ratio is equal to your market price divided by your earnings per share. Okay? Market price is always given. Earnings per share can be computed as we have discussed a while back. So when we look into the potential of a company and based on the earnings of the company, price earnings. Why price earnings? Price is for the market price. Earnings or earnings per share. That's why it's called price earnings. Yeah. Next, dividend yield. Dividend yield. So when we look into your dividend yield, how much income can we get out of our price? How much income or how much is our yield or income out of what we paid? So market price is what you paid and dividend per share is your income. So again, dividend yield, how much is our income or yield in what we paid. So again, this is a signal to your investor that I paid this amount, but I received this one. So I yield at least 10% or 20% out of my investment. So dividend yield is a measure of a common stockholder's return for the period. As we said, return, income, or yield. It shows the relationship of common dividends per share to the market price. So dividend per share divided by market price is dividend yield. How much income or yield or return did we get out of what we paid? The market price is what we paid. The dividend per share is the income on what you paid. And then lastly, dividend payout ratio. What is dividend payout ratio? The dividend payout ratio looks into how much of your total earnings is paid. That's why it's called dividend payout. How much out of your earnings is paid out to the stockholders. Why? Because remember, earnings can either be invested, reinvested, or it can be paid as a dividend. So your dividend payout look into whether your earnings is paid to the shareholders. So how much out of your earnings is paid to your shareholders. So dividend per share divided by earnings per share. It shows whether a firm pays out most of earnings in dividends or reinvest the earnings internally, as we have discussed. Okay. So again, we have just finished talking about leverage and your dividend policies. So we look into now the cost, the interest, the effect on the ratios, the dividend, the different policies out of the dividend, and the effect of this dividend into our ratios. That's it for leverage and dividend policies.